Rounding out I guess, getting into the last 2 months of this year. It's going pretty quick. So today we're going to cover vaccine updates, inflation, housing updates, the tax updates, and then certainly some of the inflationary problems that we're running into. So let's take a look at the vaccine real quick, and I want you to notice a little trend here. It looks like there are about 2 million first vaccinations happening per week. So if you look at that and said there's 4 million per month, now we're going to reach this top of the bell curve where the vaccinations will start to pull back. But some of the city mandates and some of the mandates within certain states are increasing this vaccination rate. Again, that will not last forever. We predicted that somewhere around November, December, we would have somewhere around 60 to 70% vaccination rates. We're closing in on that. And again, some of this, depending upon what your belief is on vaccination or not, it still is showing, just from the studies that we're seeing out of Japan. Japan has literally broken all the records. There are virtually no increases in cases, and it's due to mask and it's due to vaccination. Whether you believe in it or not, I'm just going with the statistics. I don't have a good feeling about it. I mean, there's been plenty of movies made about the apocalypse of humanity due to human intervention with vaccines. So I don't know. Who knows? I mean, we only know what we know now. We don't know what it's going to be in 10 or 20 years. But from an economic standpoint, right here today, it looks like we're hitting about 4 million, or actually 2 million per week, or about 8 million per month. And if you run that statistically out, somewhere around February, March of next year is probably when we're going to see this just drop off like Japan has seen. They just had a faster vaccination deployment. So unemployment right now, this week or last week, we had 281,000 new unemployment applications versus the estimate of 290,000. It's the lowest since March of 2020. Right before the pandemic hit, to give you some kind of indication, we were hitting about 256,000 new unemployment applications per week. Back then, nobody even cared. Nobody even looked at those numbers. It wasn't a real big reason. Why did we hit a lot of this, and why has it been slow to come back? Well, the more the government pumps money into people's pockets, there is no incentive, there's no motivation. Everything is paid for by them. How about the supply chain logjam? Well, we see right now there's 30,000 container cars or containers sitting in the LA port, and an equivalent amount in Savannah on the East Coast. Some of that is starting to disperse very, very slowly, but they just are so backlogged. This could take us into February or March, which means that this Christmas and for at least the next 60 days, we will probably see some massive inflation. Again, as I've stated again and again and again, I do not anticipate this inflation lasting. This is a supply chain disruption that will not and should not last forever. Now, let's move on to the tax updates. All right, first thing is, there's a lot going on in Congress right now that a lot of us just, it's like a bouncing ball. The progressives today stopped the vote. They brought the vote, or they brought the infrastructure bill from $3.5 trillion down to $1.7 trillion. But that was not good enough for people like AOC or Bernie Sanders. And they have progressively stopped any kind of vote until they get what they want. So Biden seems to think that he had gotten the Democratic votes, and he was quite frankly wrong. And so now we're back to the drawing board. So my opinion at this point is what I thought it was going to be at the beginning of the year. As we progressed into the year, I made the recommendation not to make any tax changes whatsoever until we got closer to the end of the year. I didn't want to recommend something that somebody would do for tax purposes and then have to unwind it. Now that we're towards the end of the year, and I gave the deadline of November, December, and I said if we don't see any progression by November, December, we're going to stay on the same track as we always have been. The way we process RMDs, our gain loss harvesting, our Roth conversions, any kind of tax swaps that we're doing. So November and December, if you're a client of ours, that's what you can expect. Business as normal. We did delay a lot of this in not normal procedure, like RMDs we normally do at the beginning of the year. Roth conversions we normally do at the beginning of the year. We waited until we saw it was happening. Now that I do not believe that there's really going to be any kind of changes towards the end of the year, we're going to process as normal. Now, going into next year, let's talk about some of the things that were on the table and some of the things that, they throw a lot of mud on the wall as a threat and as a leveraging tool. That's politics, right? Not all of it will stick. So let's talk about what my probability estimates are on what will stick and what will not stick. One of the things is one of these Democratic tax everybody to the nth degree, I don't even know who did it, suggested that we tax people based upon their net worth. And that's like Germany, right? Every year you pay a tax based upon your net worth, not upon what you earn, but your net worth. And that is insane. You want to talk about incentive, taking away incentive? Anyway, that is a dead deal. That didn't get anywhere with either side of the house. Remove the step up in basis. Well, that was the goal to tax beneficiaries on all unrealized gains at death. It was a middle class estate tax. That's dead. A corporate income tax increased from 21% to 25%. That's about 90% probable, I believe. Removal of the SALT, that limits. That's the state and local income tax. Depends on what state you live in. If you live in a tax-free state, you're probably not exceeding the $10,000 annual limit for state and local income tax. That would be if you're living in California, New York, Illinois. Of course, you want that limit removed because you're probably paying a huge amount in state and local income tax, right? And that would be obviously state income tax. It could be property tax. It could be all those different local taxes. There's probably about an 80% probability. And it's obviously because the Democrats control those states that have that limit that affects them the most. Personal income tax increased to 39%. Total could be up to 45% depending upon how much you earn in a given year. I think that's about 90% probable that that's going to get pushed through. The large retirement plan annual tax. Well, this is for $5 million retirement plans or more. Probability is about 90%. I've said this for years. Do not put too much into retirement plans. Sooner or later, they're going to come hunting for you. And everything that I've seen in the last 2 years, everything from the Secure Act to the change in the RMDs to just everything that they're doing is going after retirement plans. Why? It's easy money. It's an easy kill. Elimination of most 1031 exchanges. I should say elimination of the 1031 exchanges. This is where you can take a piece of property, you can sell it and buy another property within a period of time. As long as you follow the regulations, there's no tax on that. And you can continue to defer it until you die. And then when you die, you pass it on to the kids with no tax. Well, it looks like there will be a change, but there'll be a cap on the change, about $500,000 annual cap on that. It's better than nothing, or it's better than taking it away in its entirety. And it just means that we might get creative. If we have a large piece of property, we might bifurcate that into different owners. And we might then see if we can qualify for the cap under different owners. If you have 5 different owners on a piece of property, maybe that'll increase the cap to $2.5 million. We just have to see what our workarounds are going to be once that law actually gets changed and we see the actual regulations. Okay, estate tax. Well, currently that's at $11.2 million. And that was planned on moving back to $5.7 million in 2026. Here is what I think is 99% probability is that they're going to move it back to $5.7 million, not in 2026, but on January 1st, 2022. That's just coming up here in about 60 some days or so, right? One of the plans was the removal of the grantor trust benefits. That's ILITs and note sales. I think that's going to be dead in the House. It didn't get much traction. And it would literally disadvantage insurance companies, banks, financial institutions in the billions and billions of dollars. So I think what they're doing is they're going, how much tax can we capture if we get rid of this tax benefit? But then how much revenue, tax revenue, would we lose from the financial institutions and banks? And I think that that's going to be pretty much dead. Capital gains tax increased from 15 to 25%. I think there's about a 50% probability. One of the other things is limiting losses on businesses going back or forward. I think there's about a 90% probability of that. Increasing the tax on dividends. That's a removal of the preferred dividends tax status. that's gaining some ground right now. So I think that has about a 25% probability of passing. This one is just I could go off on a tangent on where politicians come from. Do they have any clue what they're proposing, what the cost is, what the burden is, or does it just sound like a good idea to them? I really wish that every politician had to successfully run a business. I wrote a paper years ago, and I said, the one way that we could balance our budget is every politician has to balance their own district. And then the federal government has to balance their budget. For whatever the amount of the deficit is, the politician would have to pay that same percentage of their net worth back to the federal government. You want to talk about incentive. You know how quick we would get a balanced budget? Or no politician would run for office. Because it's so much easier for them to say, hey, I tell you what we'll do. We're going to track every single taxpayer of every $600 movement. And what I'm talking about, you take $600 out of your checking account. They want the bank or the financial institution to report that. You want to talk about Big Brother up in your business? Man, that's worse than traffic cams, right? So you move money from an IRA to another IRA. They want to know that. $600, right? You move money. It's insane to think that anybody could actually propose such a thing. They even moved it up to $10,000. Every $10,000 money movement, it's dead. There's just not any traction on this. And I'm going to talk about this reason why they thought that this was a good idea in a minute. Corporate alternative minimum tax. They're not calling it alternative minimum tax, but basically what they're saying is that if a company has a profit, but even though that profit might not have a tax on it because of depreciation, because of offsets, because of deferrals, because of the type, they're going to tax it anyway. Now, the reason that they're doing this is because there's almost $7 billion, there's 200 companies right now that technically have a profit, but they don't pay tax on the profit. So here's what that's like saying. Hey, we're going to go ahead and offer you a 401k, right? You can go ahead and put that money in before tax. Oh, wait a minute. You know what? You've put it away before tax. We're going to double tax you on that right now. So that's really what they're proposing. The problem is it only affects technically right now 200 large public companies out of the 25,000 public companies. 200, that's it. They're talking about raising $12 billion over 10 years with this. That's $1.2 billion a year. It's virtually nothing. So you might say, well, what is the real intent of this? Like, if they're only going to raise $12 billion, come on, we have to be a little suspicious of these guys, right? And ladies, well, here's what it really is going to do, in my opinion. It's really going to tax all of those smaller companies. Those companies that really don't have the revenues to say, hey, we can pay you 15%, even though we didn't really have a profit. And how could you say, well, how could a company not have the money to pay it? Well, because you could show a profit because they allow you deductions on certain things and deductions on things that aren't there. So here's an example. Let's say that you buy equipment. That's depreciated over a period of time. You spent the money on the equipment. You have the equipment, but you can't deduct 100% of it. So if you spent $1 million on a piece of equipment, you might only be able to deduct 20%, which is $200,000, right? So you still have $800,000. So even though there's a way to wash that out right now, they're going to say, well, you now have to pay tax on the additional money. And there's all kinds of little revenue-raising rip-offs that they're proposing. And it's not going to affect the public companies. Remember what the public companies do, right? They just issue more stock. It's the smaller, privately owned companies that this would devastate. The new IRS, well, look, they're asking for $80 billion to hire more and audit more. Now, here's the proposal that they gave to the American public. Well, it's theirs to audit those people that have not paid tax. Now, the tax estimates are right now from the IRS is that there's $7 billion in unpaid taxes. So in other words, there's enough people out there that are not paying taxes. It equates to about $7 billion. Do the math. I'm going to spend $80 billion to hire more people in the IRS to chase down the people that didn't pay $7 billion. Are these the same people that put the post office $80 billion in bankruptcy for just retirement plans and another $60 billion in bankruptcy for their health insurance benefits? The numbers don't work, right? But it is a way to control the Americans more than ever before, because now you got a huge IRS force. And, it's a great way to say, get those people that didn't pay that $7 billion in tax, because, us people that do pay taxes some people would get angry about that. They'd say, yeah, get those people. What? The math doesn't work out. It's better to let the $7 billion go and not spend $80 billion on the IRS. Anyway, I think that this is really the grand plan to track every little dollar, because, how do you spend $80 billion to hire enough people to track down those few people that don't pay taxes? It's really to start bringing back things like monitoring this $600 cash movement per person. So let's talk about the 4 pillars of tax planning, because as we get closer to the end of the year, and especially into the beginning of next year, I'm going to start teaching this over and over and over again. There are 4 pillars: deduct, defer, shift, and offset. And let me explain this. Most people, I would say, if you have a CPA or a tax advisor, you're probably getting most deductions. We do a 3-year tax look back where we'll take somebody's tax returns over the last 3 years. We'll review them. I can tell you that only in about 10 to 20% of the time, people are not taking the deductions that they should. Now, I will tell you, if they're using their own tax prep software like TurboTax or like Kiplinger's, you're probably missing a lot of deductions. We just found another issue with TurboTax this year where it's not carrying forward certain deductions and credits that you could have gotten last year. And unless you know where those deductions and credits lie and you manually bring them forward, it's the programs are not bringing them forward. So there's little things like that when people try to prep their own taxes that they're not catching, but it's not a huge percentage. Defer is kind of the simple one, right? Save into an IRA, save into a 401k. Now, that is not always the best thing to do because you could backfire it. However, there are some deferral strategies like a Delaware statutory trust, a 1031, a step up in basis, certain types of trusts, where we don't pay the tax now, but we can keep pushing it forward. And if it's done correctly, now an IRA and a 401k, you can defer it, but if you defer too much, they force you to take that money out, and then what ends up happening, you increase your taxes. But there are deferral methods that you can actually wash the tax out. Shifting and offsetting. I'm going to wait until next week to go through these because they're a little bit more complicated, and I want to make sure you really understand how to shift taxes and income and offset. And the big stink is, Elon Musk is worth $230 billion. He's worth as much as Bill Gates and Jeff Bezos together. And he only paid $4,500 in income tax last year. He didn't take the income. That's the way our system works. So if you learn how to defer or shift or offset, you can grossly reduce your actual income tax bill. But it also depends upon your lifestyle, right? If you want to live life and cars and planes and all kinds of crazy stuff, you might have to take income unless you can stack and have businesses pay for it. But not everybody's eligible to do that. But if you want to live, a very reserved life like Elon Musk now does, in a tiny house, as a matter of fact, then he's not taking a lot of income. So why should he pay a lot of tax, right? Let's face it. If he dies right now with $230 billion, the estate tax on that alone is going to be $115 billion. That's where the tax gets paid. So I hope he has some really good estate planners working on his plan. Anyway, housing, 45,000 new foreclosures. This is up 68% increase from same quarter in 2020. We have a 37% increase in third quarter versus second quarter. So right now there are still 1.6 million mortgages in the foreclosure process, and there's no additional extensions from the government. That's a 30%. I'm estimating 30% of the 1.6 million foreclosures in forbearance will foreclose. Now, if we look at how this works, late 2022, interest rates are set to increase, preventing many people from refinancing. 2008 to 2010, when we had our Great Depression or Great Recession, there was 1.6 million mortgages foreclosed, causing up to 65% drop in real estate, right? And some places were worse. 2021, if we take a look at those numbers at 1.6 million mortgages that are in forbearance, even if 30% of those mortgages foreclosed, it could mean up to a 20% drop in real estate value. However, mortgage foreclosures generally take up to 1 year to foreclose. It physically foreclose, but it doesn't mean that they're not pushed into the market. So this is why when we talk about, second quarter, third quarter of next year, this is where that estimate comes from. All right, on the S&P 500 market, we are now closing in on a 24% rate of return for the year. Still doing well, as I've said over and over again, with $5 trillion sitting on the sidelines. I think that we still have a lot of punch left in this stock market. It's not like it's going to continue. It will be an artificial one, but I am not changing my econ map. I'm still on version 7, still right on time with everything, where I think the circle of opportunity with real estate is going to be the summer of next year. I think we're going to start to see a big change in the stock market by the end of second quarter of next year. And I think those tax changes, which is the red line, nothing has changed. I'm still pushing those tax changes off until next year, and I do not believe at this point they're going to have any effect on the stock market. It'll be the velocity of money coming into that effect. Roaring 20s playbook. Hey, spending spree. We still got $5 trillion sitting on the sidelines. I'm not moving off this point yet, and it's all just held up right now by that supply chain. But once that supply chain opens up, wow, floodgates. Dam is going to break. So what do we do right now? Same as I've always said. Let's get your plan in place. Let's make sure that you are doing the things that you can do before the end of this year. Make sure your investments are correctly structured. Make sure you have the right amount in each one of your 3 buckets, especially if you're in the distribution phase. And that brings me to Wiser Retire. Hey, I set this thing up, a Wiser Retire, because a lot of clients that are in the distribution phase, they might be retired 60s, 70s, 80s. They're coming to us and saying, how do you help my kids? How do you help my grandkids? How do you help my nephews? And we were really never set up for helping somebody just trying to grow money. We are experts at teaching people how to distribute money. Growing money is actually a whole lot easier than it is to figure out how to distribute it. But for those people, we set up Wiser Retire. And you can tell your friends, family, wiserretire.com. Go there, and there's a free setup on how they can grow their money. You can also invite them to, right here, this web channel, the YouTube channel. Just tell them to Google Wiser Retire on YouTube. And once they get here, just hit subscribe, and they'll get the weekly broadcast that I do. Now, if you're in the distribution phase, same old thing. Just go on to YouTube and Google H&H Retirement on YouTube. You'll get this page. Hit subscribe, and we will keep in touch with you. And this way, you'll also get notified when I start doing any kind of educational videos. With that in mind, closing up our time for the weekend. Have a great Halloween, and we will talk to you next week.